All right, welcome back to day number 10. We are at Sunday, April 10th, or on the 10th way to get started in real estate investing for my video series for Financial Literacy Month here in April. Again, like I've been keeping count, this is way number 10. I'll be covering 30 ways, many of them kind of unique to ways to get started in real estate investing. So if you haven't already, be sure to hit that subscribe button so you never miss an episode here. Now, again, just to reiterate, all these videos I've done are unscripted and unedited. So apologize if, they're not the professional and really smooth and best color contrast and all that wonderful stuff. I'm just worried about getting the content out there as quick as I can. So today we're going to talk about one of my favorite ways to get started in real estate. And that is turnkey, or a turnkey investment. Some of the options I've been mentioning before, you might be just thinking like, well, gee, I don't know what makes a good property. I live in San Francisco, I live in New York. The numbers don't make sense to have a rental here or buy a rental, especially with the appreciation and the prices are so high and demand is so high and everything going on. And I don't know the first thing about fixing and flipping a house. I'm not a contractor. I can't fix up things. And gosh, I really don't want to be a landlord. I don't want to deal with the leasing, et cetera, et cetera. There's actually a way to just kind of skip through all of that and become a property investor, but working with a turnkey company, they do all the heavy lifting and you own the property. And basically, I don't want to say it's 100% passive, but essentially the turnkey company takes care of all the heavy lifting, collects all the rent checks, puts the tenants in, et cetera, et cetera. And you just kind of sit back, ride the appreciation, the tax benefits, et cetera. And turnkey, kind of as the name implies, is literally the property should be rent ready and a tenant already in place from the time that you purchase that. Unfortunately, a lot of companies advertise turnkey properties and they are far from turnkey. Some are, and I've heard the phrase turnkey light coming up more and more, where they do just, I'd say, the very bare bones minimum rehab possible just to get it livable almost, and maybe put in a subpar tenant, if you will. And like I said, turnkey light seems to be the phrase that I've been hearing more and more. So we're just going to talk about turnkey in general. If you go to my website, you can come across a number of turnkey companies that I've personally met with and worked with. Mid-South Home Buyers, Spartan Invest are two of my favorites that I've invested with since 2019, early 2020. Freedom Real Estate in Ohio. I'm going to visit them next month on our road trip. I've been very impressed with Danny Lynn and Flip, which were actually on episode number 4. And then there's also the build to rent models going through. If you listen to episode number 2 with Wagner and Lalasco, we talked a little bit about new construction in Central Florida, how he's looking to do about 3,600 units built. This is starting 2019, wanted to have 3,600 units built within 3 years. We'll see if he ends up hitting that or not. COVID might have changed things up a little bit, but there are many companies, many good reputable companies throughout the United States that offer turnkey products, where literally you are buying the property and it already has a tenant in place. The company, whether it's Mid-South, whether it's Spartan, whether it's Freedom, whether it's build to rent, et cetera, they manage all the day-to-day operations, the calls, the lease ups, the turnovers, et cetera, and you just own the property outright. Now, as you've probably seen nationwide, there's been a bit of a shortage of inventory just in housing in general, not just turnkeys, but housing in general. That's why, Wagner and some others are starting to go through the new construction option versus just finding homes to fix, flip, and rent out. But obviously, when you're talking new construction, you can't just snap your fingers and a house appears. You're talking, usually minimum, I'd say minimum 6 months, and that's if we are in a perfectly good operating supply chain world, which we are not at this point. So there's new construction, there's existing construction, rehabs, and like I said, there's just a big shortage out there right now. Not to say that there isn't deals out there, not to say that there isn't off-market deals out there as well, but turnkeys can be one of the easiest ways to get started in real estate investing with a good reputable turnkey company. If you wanted to even take that a step further, there's also a turnkey, I'll just say property providers or promoters like Norada Real Estate. So maybe if you're out there of, I just want to get a rental property. I don't care where it is as long as it's properly managed. I'm not dead set on, Memphis, Tennessee, or Ocala, Florida, or Birmingham, Alabama, or whatever the case may be. I'm not dead set on any certain area. I just want to get a nice rental. I don't care about appreciation. I want good, stable cash flow, a B minus property. Norada Real Estate might be a phenomenal option for you with Marco Santarelli and his team of investors. That podcast actually dropped February 2nd. I believe that was episode, oh boy, I'm losing track here. You can Google it or search it on your favorite podcast platform. It was Marco Santarelli of Norada Real Estate, and his team of advisors actually scout the entire United States, so they can actually come up with rentals that are available in markets you may have heard of and may not have heard of. One that's starting to gain traction, and I'm kind of leaning towards I might actually look into is Oklahoma City and Tulsa, Oklahoma. Oklahoma in general is not on a lot of people's radars, which, I mean, not necessarily a bad thing. A lot of people by now have heard of Memphis, Tennessee, Houston, Texas, Dallas, Fort Worth. And, as the demand is there and the inventory is low, prices go up. The numbers might not make as much sense as they used to. But some of the, they're kind of called tertiary markets or second tier markets. I kind of call them sleepy markets that not a lot of people are familiar with. My last property that I purchased was Davenport, Iowa. Not on a lot of people's radars, but starting to see some more migration trends coming from the Illinois side of the border. Davenport was known as the Quad Cities, very, very diverse employment base, and can get some reasonably priced properties with commensurate rents there as well. So just high level for the turnkey option. Now, this is buying an investment property. This is through a turnkey company, and they do all the heavy lifting, the rehab. You basically just have to qualify for the loan or have the cash to purchase it. And, I would recommend later on putting that property in an LLC or some kind of an asset protection vehicle. And the turnkey company, whether it's Mid-South, Spartan, Freedom, etc., they collect all the rents, and then they send you the rent checks via direct deposit. Now, if you've been following me on a couple previous podcasts, I mentioned a hack where you could essentially buy a property, live in one unit, rent out the others, possibly utilizing an FHA loan or a VA loan, as low of a down payment as 0%, maybe 3.5%, 5%, 10%. Typically for your turnkey property, you're going to need 20 to 25% down payment. And I don't know, I'll just kind of throw a dart at a wall here. I've been seeing a lot of properties in the 100 to 150K range. So, I mean, 20% of a $100,000 property, you're looking at $20,000 right there, plus closing costs. 25%, you're looking at $25,000. It's close to a $150,000 property. Obviously, you're looking at, $30,000 to $40,000 for a down payment. So why do I bring this up? Like I mentioned, the turnkey option is probably one of the most passive options out there to get started in real estate. Not a lot of heavy lifting involved. You don't need to be a contractor. You don't need to be a real estate expert by any means. But having this down payment might, be a little bit of a crimp on your budget. And you might be wondering, oh, where do I get that money from? Two ways to really look at it now, or I've seen that you might have some options available, is if you have a Roth IRA, and I bring this up because this is how I start my real estate investing journey. With a Roth IRA, the money you put in goes in, you already pay taxes, so it's after tax, and that money grows tax-free from that point on. Really great benefit. The nice thing about a Roth IRA versus, say, a traditional IRA, you've already paid taxes on that. And on your contributions, not the earnings, but your contributions, you can take out tax free because you already paid the taxes. Now I say the contributions, not the earnings. So just kind of giving a few numbers here. Say you put in $10,000, you've picked a good tech stock, and that $10,000 grows to $20,000. That last $10,000 is your earnings or growth. The $10,000 you put in is your basis or what you put in. So in that case, we'll just give an option. Like I said, just keeping this simple here. You have 20K in your Roth IRA. We had mentioned the $10,000 cost basis. You could take out half of that, no taxes owed, nothing. You could take out the entire $20,000 if you wish. Typically, now you've already paid taxes on this, but if you're before the age of 59 and a half, which is the minimum withdrawal age for a Roth IRA, your $10,000 basis would be tax-free. The remaining $10,000 would usually be subject to a 10% penalty. So $10,000 would come to $1,000. So out of a $20,000, you're probably looking about, maybe 18, 19,000, depending on your tax situation that you would have to pay in fees there. So that's an option to pull it out of your Roth IRA. Maybe you're looking at it's like, well, geez, I've been told for years to just stick money in my Roth IRA or my 401k and let it grow. I'm not saying you have to do this. I'm just saying this is an option because not a lot of people know you can take money out of your Roth IRA tax-free. You've already paid money on it. Now, if it's a traditional IRA, just a regular IRA, then it's going to be a little bit more expensive. You are going to be taxed on that at your highest marginal tax rate, plus the 10% penalty. So if you got $20,000 in your traditional IRA, by the time everything's said and done, you might only net $10,000 out of it. And that's kind of why I did these simple numbers for you to follow along. If you have a Roth IRA, you might be able to take out the full $20,000, only pay $1,000 or so with the fees. If you take $20,000 of a traditional IRA, you're left with $10,000 after all taxes and fees. So again, not to say that you can't do it and maybe you have more than $10,000 or $20,000 in your IRA, but for a lot of people, that's an option that you might not know about. With that being said, with a lot of turnkey companies, you can just invest in a property in your IRA or your solo 401k. Not a lot of people know about that as well. Now, it has to be through a proper custodian that allows you to truly self-direct. I recommend Specialized Trust and Quest Trust are two companies that I personally work with. I have not done a lot of real estate in my retirement accounts. Outside some syndications. Personally, I like the tax benefits, especially depreciation. But, retirement accounts are usually one of the biggest untouched funding sources that you could utilize for turnkey properties. Not a lot of people think about. They just kind of park the money there and leave it. And, obviously the stock market can be a little volatile. We've seen that definitely over the last 2 years. Many are kind of calling for a 10, 20% correction, whether we have a real estate crash, who knows. But, if you got a retirement account, there may be some options there. Likewise, if you have a 401k through work, at the time of this recording, in a traditional 401k, you can take out up to $50,000 as a loan. You have to pay it back, of course, maximum of 5 years. You can take out up to $50,000 or 50% of your cash balance or total balance if it's all in cash, if you sell your current holdings, whichever comes first. So if you have $100,000 in your traditional 401k, you can take out $50,000. If you're Peter Thiel and have $5 billion in your 401k, you can still only take out $50,000. Likewise, if you only have $50,000 in your 401k, you can only take out half of that or $25,000. But, depending on how the numbers work, that might be an option where you basically take the money out of your 401k. It's a loan. You're not actually taking it out for good like we talked about with the IRA options here. You can take it out as a loan, pay that loan back over the next 5 years. That could be your down payment for 20 to 25% for a turnkey option. And we'll go over the last option that I will myself be doing here probably in the next, I don't know, 12 months, maybe 18. Just, I don't know, we'll see what real estate prices are doing. And obviously the Fed's talking about raising rates and quantitative easing and tightening and all that fun stuff. So it just becomes a numbers game of, do the numbers make sense? Now, do you own your primary home, and does it have some equity in it? I believe for 2021, I was reading a stat that the average American made more from their primary home equity growth than they did at their full-time job. It was something along the lines of the average equity growth for 2021 for the average American was like 50,000, and the median or average W-2 wage, obviously before taxes, was 48,000 or something like that. I wish I remember where I saw that at, but it was an interesting statistic that, as we've been seeing this market just grow and grow and grow and appreciate, there's a lot of people that have equity in their property. And if you're interested to learn more about equity, because maybe it just gives you that good feeling that, oh, I got this good equity in my house, I don't want to touch it, I want to pay off my mortgages fast as possible because that's what Dave Ramsey tells me to do, and that's what Susie Ortman's told me to do. Just Google, go to Get Rich Education, watch a YouTube video or a podcast. Keith Weinhold has done a phenomenal job of mentioning how your growth from equity is always zero. I won't go into detail of that. I'm going to let you Google that and listen to that for yourself. But he really lays out the point of how equity in your home may not be the best thing for you. So let's just say, I don't know, I'll just throw out some numbers here. Let's say I have a $1,200 mortgage payment. And I don't know, you got this payment a number of years ago, or this mortgage, excuse me, maybe you got, I don't know, 18 years left on a 30-year mortgage. And, you're just doing what you've been told to pay out that mortgage as fast as you can. And, oh, I refinanced and, rates are really good. I was at, I don't know, 5%, 4%, whatever the case may be. And golly, your rates are going up, maybe the rate would be 6% that I'm qualified for now. So why would I refinance to get a higher rate? Well, Russell Gray always said it best: do the math, and the math will tell you what to do. So we're just going to stay here. What's the $1,200 payment? And what if we can keep that payment the same? You're already budgeting for that. You're used to that $1,200 a month mortgage payment for your principal and interest. Can we work backwards and see if there's an option to take equity out of your house and refinance this to, say, a new 30-year loan? Maybe you've had several equity buildups in your house, and I'm just throwing out some numbers. Let's say you can work backwards and you are paying $1,200 a month. You got 18 years left on your mortgage. You can do what's called a cash out refinance and work with a qualified mortgage broker, run the numbers. Maybe you can afford to bump that payment up. Maybe you want to keep it the same, maybe even lower it a little bit. But keeping it at $1,200 a month, maybe you can take out $30,000 for a down payment on a turnkey property through Spartan Invest, let's just say. And that 30K is your down payment on a new investment property. And let's just say you have refinanced out. Many people will say, well, you just lost equity in your home. Well, kind of. You're essentially moving equity from one property, your primary residence, to another one. So let's say this is your investment property, this is your primary home. And it's just shifting from one building to another through a cash out refinance. So let's say you keep the same minimum payment of $1,200. You can go to pretty much any mortgage calculator online and work backwards and say, here's my mortgage payment that I want. Usually you're probably used to the calculators. You put, I need to buy a $150,000 house. I'm putting a 20% down payment. Here's the remainder. I want a 30-year mortgage. I'm doing a 5% interest. And it works it down and say, okay, this is what your mortgage payment is. This is just working in a reverse of, you have your set mortgage payment, work backwards with the interest rate, work backwards to what the value of the loan would be, minus your outstanding loan currently. That would be how much cash out from an equity cash out refinance you can take. In this case, we're just going to say, for standard, simple numbers, We can keep our same monthly mortgage payment on our primary home at $1,200. We do a cash out refinance. We have $30 cash sitting in our bank account to put towards a turnkey property. We buy our first investment property for whoever that is. This $30,000 is the down payment. And let's just say, keeping it really simple with that investment property, it has a gross rent. Obviously, you're going to have another mortgage on this, minus taxes, minus insurance, minus property management fees, vacancy, maintenance, possibly utilities. Let's just say after all expenses are paid, you have $200 a month cash flow, net cash flow. So that $200 now covers 1/5 of your primary home mortgage rate. So now, instead of having just your primary home, you had just a $1,200 mortgage payment, you had no properties through a turnkey company, you refinanced, kept the same monthly payment, maybe a little less, maybe a little more, moved that equity from a cash out refinance to buy a property with a net cash flow of $200, which basically offsets 1/5 of your home. So your tenants are essentially paying the mortgage on your your investment property, as well as a portion of your mortgage of your primary home. Could you do that again in a couple of years? Maybe you do a cash out refinance of the investment property, repeat the process again, maybe pay another portion of your primary mortgage. Then you own your primary home and maybe 2 investment properties, all starting from the equity of your primary home to purchase a turnkey company. Keith Weinhold has always said the return on equity is always 0. I will just leave that out for you to go Google and research on your own. But if you want to run the numbers, everyone's situation is a little unique, but if you don't have the time or contracting skills to do a fix and flip or some of the other options for getting involved in real estate investing, like I have covered and will be covering, a turnkey option might be a great fit. And if you're a little, stuck on the 20-25% down payment of where could I get that cash from, possible loan from a 401k, taking money out of a retirement account, or a cash out refinance of existing properties or your primary home might be an option. One final note, like I mentioned before, this is an option that I'm looking at myself at doing, as I've been a real estate investor since 2016. Currently have a 4-plex, 2 duplexes, and 3 single family homes. And they're on obviously various amortization amortization tables, length of time left over, anywhere from one's got 9 years left, some 27 years left, somewhere on higher 20-year amortization, somewhere on 30. But essentially, I'm doing this process, and I've ran the numbers numerous ways, conservative numbers, but basically looked at the numbers and keeping we'll say my block of monthly payments the same. So that's the mortgage payments across all the properties, keeping that the same, refinancing that into what's called a portfolio loan, or it might have to be 1 or 2 loans. Portfolio loan is basically you have one loan, and that one loan encompasses multiple properties. Now, the catch with that, with a portfolio loan or what's called the non-QM loan, many times the lenders don't want to have properties more than like 2 geographic areas. Sometimes they just want in 1 state. So since my properties are across 5 states, might have to do some cash out refinances and a couple of different loans. But regardless, going to be looking at refinancing them into cash out refis of 30-year loans. And even if interest rates do go up, which they probably will, not exorbitantly, I don't think, but I think they will be going up. I've ran the numbers that I can even do this at a 7% interest rate across all the investment properties, and have even just factored in what they were worth a year ago, haven't even factored in appreciation, keeping the sum of the mortgage payments the same. I've ran the numbers. On a conservative end, I would be able to take out $100,000. On the, shall we say, optimistic end, up to $150,000, I would be able to take out tax-free, all cash, for down payments of additional properties, looking at Central Ohio through Freedom Real Estate, and ideally would love to get a new build fourplex in the Central Florida area. So Wagner, if you're listening to this, please get on those buildings of the fourplexes you've been telling me about. So yeah, cash out refinance, pulling some extra money out, whether it's $30,000, $100,000, $150,000, utilize that cash as down payments in a turnkey property and rinse and repeat as time goes on. So that's the end for today's video, video number 10 here on Sunday, April 10th. Of 30 ways how to get started in real estate investing. I'll be back to you our Monday's video of way number 11 of how to get started in real estate investing. Take care.